Welcome back to the Global Ledger. I'm Justin. In episode 7, we broke down what really happens during a bank run. Not the movie version, but the modern institutional balance sheet version. Today, we're going to go deeper into the system behind those runs. The system that most people never see, never hear, and never think affects them. But it does. In fact, the system touches your life every single day. It's called the shadow banking system. And despite the name, it's not illegal, it's not in the dark, and it's not a conspiracy. It's simply the part of the financial system that creates money-like promises, but isn't a bank. By the end of this episode, you'll understand what shadow banks actually do, why they exist, how they create money, and how they fund the entire financial system. And also why crises almost always start there. So let's get into it. So part 1, I want to talk about what shadow banking really means. The name shadow banking sounds suspicious, but the reality is straightforward. Shadow banks perform bank-like functions, banking functions. They take short-term funding and create long-term assets, but they are not traditional banks. They do not take deposits. They have no FDIC insurance. They do not have access to the Fed's discount window, and they do not settle payments directly with central bank reserves. But they do lend, borrow, fund markets, create money-like liabilities, support global liquidity, and intermediate credit. The most important shadow banks include, and I've got quite a bit of them I'll name off. So money market funds, it's a big one. Repo lenders, broker-dealers, securities lenders, government-sponsored entities like Fannie and Freddie, hedge funds, asset managers, structured credit vehicles, and offshore dollar banks. These institutions together form the largest source of short-term funding in the world. So maybe a good question to ask ourselves is why shadow banks exist. Shadow banks didn't appear because someone wanted to hide something. They appeared because investors want safe, short-term, interest-bearing assets. Markets want flexible funding. Banks are extremely regulated. They appeared because the economy demands credit growth as well, you could say. And institutions need liquidity on demand. And banks alone they can't supply all the money-like assets the world wants. So the shadow system evolved to fill the gap. And the money market, I should say, is really no longer the banking system. Shadow banking is the real money market now. Collateralized lending is a good thing to start with. It's the core mechanism. Most shadow money comes from one mechanism, and that's repo. This is better known as repurchase agreements, and these are short-term loans backed by securities, and mostly treasuries. Here's how it works. So a dealer or fund sells a treasury today. They agree to buy it back tomorrow. And the difference in price is the interest rate. This transaction is safe, short-term, clearly it's collateralized, and functions like a deposit for institutions. So to money market funds and large players, repo is cash with yield. To the borrower, repo is funding with collateral. This is why repo is the beating heart of shadow banking. And so that brings up another thing, which is what is the difference between shadow bank money and bank deposits, you might ask? And I would say traditional deposits are guaranteed by the government. They also settle through the Fed. They are backed by bank assets and are protected in bank runs, like we discussed in the last episode. And shadow money is not insured, depends entirely on collateral, settles through private contracts, and can fall instantly if collateral loses value. So now here's the key. Shadow bank money behaves like deposits until the moment it doesn't. And that moment, well, is a crisis. So let's talk about why shadow banking is fragile. And here's the real risk. So shadow banks rely on collateral chains. The same treasury can be lent and relent many times. So this works beautifully when collateral values are stable, volatility is low, and dealers have balance sheet capacity. But when markets stress, collateral haircuts will increase, lenders pull back, securities drop in value. What else? Repo funding dries up. Borrowers must delever. Forced selling triggers price drops, which triggers more margin calls, and so on and so forth. This whole series is known as our series of events is known as the collateral spiral. So it is the shadow bank version of a bank run, and it's faster, much faster than a traditional run. This is how Lehman collapsed. This is how the 2020 crisis began, and this is also how we got the 2019 repo spike. So the shadow system is incredibly efficient. Well, until it isn't. So this takes us into another issue with the Fed. Call it an issue. But why the Fed must backstop the shadow system. So even though shadow banks are outside the regulated banking system, the Fed cannot ignore them. And why is that? Because the shadow banking system funds treasuries, dealers, mortgage markets, credit markets, corporations, and provides the dollar liquidity for global finance. If repo collapses, everything collapses. So the Fed steps in, and it did so in 2008. It did so in 2019, 2020, and 2023. And not because it wants control. Let's keep that clear. But because the alternative is systemic failure. So the Fed may not regulate shadow banks, but it must support their liabilities in crises. So interesting. Let's touch on this. How does shadow banking affect my life, your life? This isn't just institutional stuff. Shadow banking influences mortgage rates. It influences money market yields, bond liquidity, stock valuations, dollar strength, credit conditions, interest rates. What else? Commodity prices. So when you have a healthy repo system, liquidity can flow, valuations expand, borrowing becomes cheap, and markets markets can function smoothly. But when repo seizes, liquidity vanishes, spreads will widen, borrowing costs spike, credit will freeze, and asset prices will crash. So whether you know it or not, your financial life runs on shadow plumbing. And again, understanding the structure, the mechanics of this, at first it sounds scary. Shadow banking in itself inherently sounds scary. But once you understand it, the mechanics of that with collateral and repo and money markets and balance sheets and et cetera, the system stops feeling and seeming like a mystery. It starts, operating like a machine, and machines can be understood. And that's the mission of this show. And I want to thank you for joining me in episode 8 of the Global Ledger. This was a lot to unpack in the 15 minutes or so that we've been together. But it is extremely important, an extremely important topic. I think the next episode, we're going to go deeper into the system's core engine, and that is the repo market. And you've heard that over and over and over again, and it's important. So we're going to discuss the repo market in the next episode, and this will be one of the most important episodes in the entire series. So once again, I'm Justin, and thanks for being with me.